Hey everybody, good to be with you today. It is Wednesday. That means it's managing an options portfolio day. My name is Brent Morse, and just glad you're here. Those of you who are first timers, never been here before, we welcome you, and well, we're going to welcome everybody else too. And if you're watching on a recording, that's great as well. What we do in this webcast is we talk about managing options positions, and usually we kind of hit up another topic or two along the way. And sometimes we get questions along the way too, and I try and address those questions. So I'm going to try and do that today before we get to managing various options positions. But just a heads up in the chat, I've got Ben Watson. I've been working with Ben over 2 decades now. He's an experienced market trader and observer. And check out his webcast, which immediately precedes this one each week, Trading Index Options. So make sure you check that out. You can get that on a recording as well. But you can follow Ben or myself on X at BrentMooreCS, at Ben Watson CS. And thanks for having me my back in the chat there, Ben. Appreciate that, and appreciate each of you. Let me go through and just mention a few important things before we get too far into this. One, options do carry a high level of risk and are not suitable for all investors. Multiple leg option strategies will involve multiple transaction costs. Short options can be assigned anytime up to expiration, regardless of the in-the-money amount. And this is material today is intended for general informational purposes only. The paper money software application is provided for educational purposes only. And the paper money virtual trading application will not assign a short option position early. That's different than your real trading account. All investing involves risk, including loss of principal as a potential. Past performance is no guarantee of future results. Okay? All right, let me switch on over, and I'm going to bring up the Thinkorswim platform. Okay, so here's the markets. This is SPX, S&P 500. We're up a little bit today. That's after yesterday. If we look at yesterday's candle, that's a hammer candle. After you pull back and you have that, that's generally perceived to be a bullish sign. One reason is, hey, look, we closed right at the high of the day. Okay, and if you looked at the trading throughout the day yesterday, it kind of, as the day ended up, market was going up. And so not probably a surprise that we're up a little bit today, but you never know on those. So that is the SPX. There's a lot of different ways to find potential trades in the market. And mostly what we're going to do is we're going to talk about managing an options portfolio, but there's just a tool that I got a question on that I want to address, and that is the spread book. Because there's different ways to trade, there's different ways to find options. How do I find examples for the various webcasts that I do? Well, very often I'm just looking at a watch list, a list of stocks. It may be just a list of liquid stocks. And I just kind of look and find, hey, this one's bullish, this one's bearish. That's certainly an approach to do it. You can do scans on the scan tab. You can use that stock hacker if you want. Maybe you hear about trades from somewhere else. But one approach that some people do is the spread book. What's this spread book? What's this ISE spread book? Basically, these are trades. It's anonymous, so nobody knows who's doing what trade. But these are trades that are either held through Thinkorswim, in the case of Spreadbook, or on the International Securities Exchange. Here, these are actual trade orders that people have put in. Again, we don't know who's putting in the order. We don't know whether they're good orders or bad orders. In other words, we don't know whether they're good trades or bad trades, but they can be an idea generator for you. Let me just look at this, but the spread book is going to look very similar to this ISE spread book. But you can sort it by the type of trade that you want up here. Okay? Or if you want to just look at a particular stock, you can do that. If I just want to look at Adobe trades, I can type in ADBE, put that in, and it's going to give me trades for Adobe right there. But if you take out the symbol entirely, then it's just going to give you various types of trades there. But let's go to spread all, and we can change it. And let's say we're looking for a calendar spread. We can look at this calendar spread right here, and maybe I want to look at, say, Intel and see what this is. Somebody's doing a calendar spread on Intel, and they're doing a September 26, October 3rd, 22 put calendar. Let me just jot that down. Actually, here's what I'm going to do. I'm going to right click on this, and I'm going to analyze this trade and just see what it looks like. I pull up Intel here, INTC, and let me just make sure I don't have anything else on here, which I think I do. Let me get rid of this. Here's the calendar spread on Intel. And then what I can do is I can look and see, is this a viable trade for me? Well, calendar spread, I want the stock to be around that 22 strike in this case. I can go to charts. I can look at Intel and say, that's kind of a little bit of a bearish take on Intel. The thought is on this that Intel is going to drop back down into this zone here, that it's maybe overextended itself a little bit on that. So that's just, that's not a recommended trade or anything like that, but it is an approach to doing, to finding trades. You want to see what other people are trading in terms of calendar spreads? You can do that. Or straddles or back ratio spreads or whatever, you can do that. And then you can do exactly what I just did, is you can just analyze the trade, which brings us up to another point here. And once you have the trade and you go, oh, I like that trade or I don't like that trade, you can always just right click and you can confirm and send that trade if you wanted to send that trade. Now, that's not necessarily a trade I want to do right now, so I'm not going to send that trade, but I'm just going to get out of that. Okay. Now, another question I've gotten recently is this. The thought is, hey, Brent, you're often looking at trades, and when you look at trades that are in this class in particular, I'm looking at these and we analyze these trades. Okay, fair enough. We do that. But the question then was, hey, what if I want to look at a potential trade, not a trade I'm in. How do you add those? Well, you can go to the Analyze tab, you can go to Add Simulated Trades, and then you can do a trade. So here's what I'm going to do. And this is going to combine with a different question as well. I'm just going to look at Apple as an example stock. It's not a recommendation. And I'm going to say Apple is trending up. We had a nice little bounce off the 20-day moving average. Apple seems to have benefited, by the way, from that Alphabet ruling in the courts yesterday that came out that said Google doesn't have to strip out its Chrome browser from the Alphabet product, okay? And Apple, why did Apple benefit? Well, Apple gets about $20 billion a year by having that as part of its native system as well. So Apple benefited, but the point is, we have a trend up on Apple. Let's say we wanted to do a trade on this. In this case, let's just do a synthetic trade. So this is going at your question here, Ray. How do we do a synthetic here? Look at it on this, and then we'll maybe look at some protection on that. So what's a synthetic? A synthetic is basically an options position that mimics an options position that mimics long stock, buying the stock in a lot of ways. Now, it's not exactly buying the stock. There's expiration dates when we do a synthetic. You don't get a dividend. If Apple pays a dividend, which it does, typically, no guarantee for the future, you're not going to get a dividend on this. But let's do a synthetic on this. So, and the only reason we would do this is if we're bullish on Apple. Okay, and so that's the premise of this trade. So I'm going to bring up Apple, okay, and let's do this. So here's Apple, and I'm going to go out, and I'm going to go out 79 days here. So we've got a synthetic, so I'm going to do a synthetic on Apple. I'm going to go basically at the money. Stock's at 236. I'll go to about 235, and I'm going to go. And I'm going to, well, maybe I'm going to try and match these a little bit here. So I'm going to go to 240. I'm going to buy the call, and I'm going to sell the put. I'm going to hold down the control key and sell that put. Okay. So this is a synthetic. Why do we call it a synthetic? Well, actually, you know what? I wanted to show you it a different way. I wanted to show you on the Analyze tab. If you go to the Analyze tab, go to Add Simulated Trades, and do the same thing. It's going to look just like an option chain right here. We said we were going to go out to, I think, November 21st. I'm going to do this. I'm going to click on the call. I'm going to click on the bid price on the put. And there's a synthetic. What does it look like? Click on risk profile for Apple. This is what I've got. This is basically what the risk profile looks like on a long stock. The higher the stock goes up, okay, here's this underlying stock price down here on the x-axis, okay? The higher that stock goes up, the more profit you make. The higher the stock goes up on the synthetic, the more profit you make. The more it goes down, the more you lose. So can you see why we call it a synthetic, why it looks very similar to just buying the stock? That's what buying the stock would look like for the most part. Okay? So that's what a synthetic would look like. Now, maybe you want to tweak it a little bit more. And you want to say, well, I'm bullish on Apple, but I'm a little bit concerned. I want to put on a protective put at the same time. Well, you can do that. Go to Add Simulated Trades. And your put doesn't necessarily need to be the same expiration date as the long synthetic. Maybe it's a shorter term thing. Maybe you're going out just a little bit. You're worried over the next couple weeks on this. Well, I can go here, and we said it was a 240 call. So I'm going to go to 235 put, and I'm just going to click on that. I don't have to hold it. When I'm on this Add Simulated Trade page, I don't have to hold down control or anything. That is now look what we have. We have a synthetic, okay, 240 call, 240 short put. So 240 long call, 240 short put. That's a long stock synthetic with a protective put on that. What does that look like? Well, let's click on risk profile. Here's what it looks like. Okay. Notice when we look at this, we'll look at price slices as well. Notice when we look at this, our gains are capped out, or excuse me, our losses are capped out because we have that long put there as well. And that looks a lot like a long call, doesn't it? Looks a lot like a long call because why would that be? Because look, I've got a long call, but then I have a short put and a long put, which sort of cancel each other out. Now they have different expiration dates. Okay, they have different expiration dates, so it's not exactly the same as the long call, but that's what it looks like right there. In terms of our Greeks, well, here's our Greeks for where we currently are. It's very positive. Delta 57, theta, time decay is working against us. We have two long positions here. We have a long call and a long put. That's going to give us that negative theta there on this. Okay? All right. So anywho, that's how you can look at this. Now, how do we manage synthetics? This is another question I've gotten. Okay? And how do we manage synthetics? Let's put aside the short put aspect of it for now. Excuse me, the long put, the protective put aspect of it for now. When you're trading a synthetic and you're talking about management of a synthetic, then the way typically it's going to be managed is the same as if you would be buying, if you bought the stock. How would you manage this if you bought a stock? Well, likely there's a good chance you'd put in a stop loss on this. So we could put in a stop loss. Let me go back here and let me just double check. I want to make sure I got the question here from Ray with put protection $5 below the one sold. I think we did that. What would like the delta in the Vega? Yeah, so that, hopefully that answers your question there, Ray, on that. But if I got this management, if I'm managing this, I'm going to manage it like a stock here is the management on these long puts here, on these long synthetics. We're going to manage it like the stock. So we'd say, well, maybe I have some support down here. Would it make sense then to put a stop loss below this level? Because if we go below this level, it looks like that trend is probably changing at that point. One way to think about the trend changing is this. We have a high. This is kind of breaking to a new or higher high. We had a low. Here's a higher low. And here's a higher low. If we're breaking below here, that means we'd be getting a lower low at that point. And so that's a good sign that maybe it's time to exit that trade. Okay? All right. Let's go forth. And I want to look at some other positions here and do that. But that's management of a synthetic. I don't think I have any synthetics in our existing portfolio. And therefore, I wanted to show you that because we have a whole bunch of different positions in this portfolio. Okay. All right. So let's go and look at some short verticals and the like here. And let me just make sure, see if there's any other questions here. Ben, thank you for helping me out on that, on questions. Let's go, let's see. Is there a delta value? This is from Harry. Is there a delta value that gives one the best balance between profit and loss? Depends on the type of trade, I would say, Harry. It's a good question. It's hard to give just a blanket answer on that. A delta value, it's just going to depend on the trade is kind of would be my answer on that. In terms of, say, a long call or something like that, the higher the delta, it just becomes a trade where you get bigger potential gains or bigger potential losses. But there's other factors in there that play into that. Okay, and so, for example, let's say we do something with the high delta. It's going to cost us more, but if the stock goes down a lot, we're going to lose more on a dollar basis. But keep in mind, on a percentage basis, as compared to the price of the original stock, the lower delta is actually going to be more leveraged from a percentage basis there. So I know that doesn't totally answer because there's no blanket answer for you on that, Harry. But just remember, like on a long call or long put, the higher the delta, the more dollar value movement you get in that option. But in terms of percentage, the percentage is actually probably going to go down some. And therefore, we're going to say the lower the delta, the more leveraged that trade. Okay, now let's take a look at some short verticals or iron condors. I have Adobe here. What's Adobe? This is an iron condor, right? We've got a short put vertical right here. We've got a short call vertical right here. Where's our stock? Our stock's at about $346, which is kind of right in between these. Now, here's the interesting thing. We're actually down a little bit on this trade. And I'm not sure why. It may be an implied volatility thing. It probably is an implied volatility thing because, you know what? We've got earnings coming up in a week on this trade. Now, we could hold this a little bit longer, But what I think has happened is, even though the stock has done mostly what we're going to do, mostly what we want it to do, the implied volatility, remember, if implied volatility goes up, it's going to hurt the trade. I suspect that's probably what happened, happened to these contracts on Adobe with earnings coming up. Now, Adobe doesn't come out until we'll have this session again next week. So we could wait and see, because there's a good chance that the implied volatility effects have already taken their toll on this. But for our purposes, here's what I'm going to do. I'm going to just take our loss, $7.50, and say, you know what? It didn't work out. We're just going to get out of this trade. Time is passing. I don't want to worry about earnings. So I'm just going to create this closing order. I'm going to get out of this. I'm going to confirm and send, and I'm going to send that. Notice when I'm exiting this this iron condor, I'm getting out of the put side independently of the call side. Okay, I'm going to create this closing order, and I'm going to get out of the call side. And the reason is, it's usually easier to get out. Usually it's easier to get filled if you get out of one side at a time there. Okay, so that's Adobe. Let's look at the next one. What do we have on Southwest Airlines? I have a short call vertical. We are losing money on this, a little bit, 28 bucks on this. We have less than 10 days to go. When we're about a week till expiration, we're just going to say it's time to get out of this. We've given it our best shot. We're not going to let it go all the way to expiration. One reason is this. It's what we call, I guess, gamma risk in a sense. The closer you get to expiration, the bigger the changes or fluctuations we can see in this. This can go from a very small loss to a much more substantial loss in very little time as we get very close to expiration, which is why when we're about a week out till expiration, we're probably just going to look to get out. Now, it may very well go in our favor, but keep this in mind. With a short call vertical or a short put vertical, ultimately, when you enter those and when you do them out of the money, which is what we did, your max loss is much greater than your max gain, okay, typically. Typically, your max loss is potentially greater than your max gain. And therefore, when we get down to towards expiration, I would much rather prevent against this max loss scenario than what I can potentially gain by holding on for my max gain scenario. And so, if I can get out with a $24 loss, I'm looking to get out of that $24 loss. Remember, we're trying to cut our losses short and let our winners run for the most part there. That's the goal of this portfolio. I'm just going to cancel my stop orders on this, and I'm going to look to get out of this Southwest Airlines trade. Okay, so I'm going to right click on this. I'm going to create a closing order. I'm going to buy that back and get out of that trade. Okay, any questions on that? Let me know. And that's how we're going to manage those short vertical spreads here. Okay, so there's a short put vertical. This is Meta is going to be kind of a similar. We got another loss on Meta too. So we've had a few losses on our short verticals, but we're going to manage. Okay, this is we're down $200 on this. This trade has obviously gone against us substantially. This is a short put vertical. 767.55 put. We want the stock to stay above 760. The stock right now is at 738. So this has gone completely against us. It can certainly get a lot worse than where it's at right now. But again, barring barring a huge jump, we're going to end up in a max loss position on this. And I don't want to get to that position. So even though this is going to be kind of costly and we got to take our lumps, this is one we're going to close out of. And we're just going to get out of that trade. Okay. We're going to send that. So I think those were most of our orders that have gone really far south on us. Let's look at AT&T. We've got another iron condor here on this. Stock's at almost 29. It's in between our strikes. We're making money on this. Time decay is helping us out on this. Theta, positive theta, to the tune of about $4 a day, which isn't massive, but that's what you get on an iron condor. It's a slower mover. We still have 16 days to go to expiration, so I'm going to let that one sit. On short verticals, including iron condors, we're going to have a time expiration. In other words, if we're about a week till expiration in this class, we're just going to get out of those. That's kind of how we typically do it. We're going to have a max gain expiration. If we've made 80% of what we can make on this trade, then we're probably just going to get out of that trade. And if we're going to have a loss, if the stock breaks down technically, we're going to look to get out. Those are kind of the three things together that we're going to look to manage these. In this case, we're not losing, we're making money. We still have 16 days to go, and we still have a little ways to go in terms of potential profit on this trade here on this. So we're going to let this cook a little bit longer here. So those are our short verticals on that trade. Okay, let's go to long single options. Here's long single options. I've got Adobe. What do I have on Adobe? I've got 16 days to go to expiration. Now, in the case of a short option, under 10 days, we're typically going to let that time decay help us until we get, unless there's some other reason not to, until we get to under 10 days. In this case, is time decay helping us? No, time decay is not. In fact, it's hurting us in a big way. We have a negative 42 delta, or negative 42 theta on this. So we're losing about $42 a day. Okay, we're losing about $42 a day, everything else being equal, just by holding on to this. Now, we're up a couple grand on this. That means the stock's done very well in terms of our trade. We have a bearish trade on this. But with 16 days to go, I think I'm just going to capture my gains here on this. Now, other reasons we would get out. Well, if it turned bullish on us, let's look at Adobe. I don't think it's too bullish, or else we wouldn't be making the money we're making on this. We also have earnings coming up here on this. So what I'm going to do is I'm just going to exit that. We're going to take a profit on, and that our MetaTrade filled. We're just going to take a profit on our Adobe trade. So what I'm going to do is I'm going to just, I'm just going to cancel this stop order. And I'm going to look to sell this put and realize the potential gain there on this, okay? So I'm going to create this closing order. We're going to jump out of this trade, and I'm just going to confirm and send, and we're going to send, and that was a nice little boost to our paper money portfolio there. Let's look at some others here. Let's look at AVGO. So here's AVGO. We're down a little bit on AVGO. In fact, we're down $100 on AVGO. But you know what we got? We've got, let me show you. We've got earnings. tomorrow on this, I think. Tomorrow we've got earnings. So I'm not going to sit through earnings on that. I'm going to avoid earnings. You don't have to avoid earnings, but I'm not going to speculate on that. I'm just going to get out of this trade here on this. So we're going to avoid earnings and create a closing order, and we're going to get out of that trade. Okay, easy enough. There are some trades that we intentionally target earnings and some we avoid. And this one is one I just wanted to avoid. Citigroup, here's another one. It's a long call, 2 days until expiration. I'm going to cancel my stop order, my exit orders on this, and I'm going to just exit this trade. 2 days till expiration. We're not even going to deal with that here. Okay, so there's Citigroup. We're done with that one. We're closing out a lot of positions today, aren't we? Let's see. I think those are the prominent ones that I wanted to show you. The other ones in this long, like, I'm not going to touch these. I'm not showing you them because I don't think they need any management here on this right now, okay, for all of these, okay? So I'm not going to go through every one just because I want to be able to get to some of these others. Long verticals. We got filled today on this, just to point out, we got filled today on this Apple long vertical spread. Let's just take a look and see what happened on that. Sometimes you'll see that, you'll be looking at it and go, hey, what's happening? I don't have anything. Well, that means it filled today. I have no quantity and no orders, but it's still showing up here. At the end of the day, this will go away. Okay, this will go away after today. Tomorrow, we won't see this trade on there. But if I want to look at past trades, I can go to account statement and I can put in my ticker. Here's Apple. And let me just go back. I'm just going to go back a month here, I think, on that, just to and go here. So here was the vertical spread. Okay, here was the vertical spread. We did a long call vertical, and we put an exit in, and it did what it was supposed to do. We did a bullish trade on Apple, and it was a long call vertical. We bought it for 380. We sold it for 695 on that. So that's why we're out. It just went up enough. If you want to see the exact order, okay, this is trade history. If I want to see the exact order that got me out, okay, we can go to orders, and here was my order. I had an initial order to buy. We had this 390 debit. We then had 2 orders to sell. One was it was for 678. That was our target price, which we hit and we sold out. We also had a 195 stop. This was an OCO order. In other words, because we hit our target price, it canceled this order. Now, if we hit the stop price and we sold out here, it would have canceled our target price. All right? So that one worked out. Let's get out of this trade. Let's get out and go back here. So that was Apple, long vertical on Apple. And let's look at some other trades. Let's look at calendars. Here is calendars or butterflies, or what do we have here? This is a diagonal spread. Oh, you know what this is? This is the whole poor man's covered call. This is one we've rolled before. So what we did on this one is we bought a leap. Okay, here's our leap option, our leaps option. It's a long call. And then the goal is we're going to sell these shorter term expiration calls kind of in a sense against it. This technically is a diagonal spread, okay? And bring in a credit along the way. And we've done this already. We rolled this a week ago, I think maybe even in this webcast. And so we rolled it and we brought in a credit when we rolled it, okay? That was about a week ago. The question that kind of begs the question is, look, the short put's doing okay, the short call's doing okay, the long call not so much. But hopefully we'll be able to keep on rolling this and bringing in a credit along the way. And if we do, even if we have a little bit of a loss on the long call, it may make up for it. You just don't know. It just depends on how big that is. But this is a positive delta trade overall. I mean, my delta overall on this is roughly, 73? But stock's not really cooperating right now. But our goal is to roll. But do we roll right now? Well, what I would say is this. Number one, if we're getting near expiration, we're going to roll. Well, we still have 16 days, so I'm not going to do that. If we have made 80%, you can use 70, 90, I don't know the exact number, but for this webcast, typically we use 80%. Then we may look to roll. Well, we sold it for 88 cents. It's at 30 cents, so that's not 80%. Okay, so there's still enough meat on the bone, so to speak, to let this sit. We're going to let this sit, and hopefully the time decay is going to help us out. Now, let's talk about when we should completely call it quits. Question, when did I sell the call? We sold the call on the 20th. Okay, so that was, I guess, 2 weeks ago we sold that call. August 20th, we sold that call. Now, this trade, the assumption on this trade is we have a long-term bullish forecast on Nike. If we change, we can look at the stock. If we change and say, no, I'm just bearish on this, then you know what we're going to do? We're just going to get out of the whole shebang. At this point, I'm going to continue with our long-term bullish forecast on Nike. Okay, doesn't mean it's going to happen, but that's the premise of the trade there. So we're going to stick with that here. Okay, let's look at a couple others here. Here is Comcast. This is one that we entered just the other day here. What is this? This is kind of a weird trade, isn't it? I've got two contracts of a call at 34.50. I've got one contract, long contract, those were short contracts, of a 32.50 call, and one contract at a 35.50 call. This is a skewed butterfly, everyone. Now, if you're going, I don't know what a skewed butterfly is or how they work, let me just mention this to you. I did a webcast the other day. In fact, on Friday I entered these trades just a few days ago on Fridays. And if you want to see what a skewed butterfly is, I'll put a link in the chat for you. And if you're watching on a recording and you don't get the chat, it's okay. You can go to Advanced Options webcast on August 29th. The webcast is called Butterfly Variations. Okay, so the point is, we've only been in this like a couple trading days at this point. Not much has happened. We're going to let that sit. That is true for both CMCSA and Schlumberger, Comcast and Schlumberger. We have a skewed contract. If you want to see how what these look like, again, you can go to that Analyze tab we were looking at. Let me go to Schlumberger here and just take a look. And let's go to risk profile and see what it looks like. This is what it looks like. A normal butterfly, non-skewed that is going to have a risk profile that looks kind of like roughly, very roughly, this. Notice this is kind of asymmetrical though. We have a lot more risk down here than to the upside up here. And so we've skewed this to be more bearish, this trade on Schlumberger. Right now, here's where the stock is, right here. Here's where, so far so good, but we just got to give it time. We just got in this a few days ago, so we're going to let that one sit as well there. So that's Schlumberger. And let me just see. We're just about out of time, but I want to look at another one. Let me just look at Comcast, CMCSA. I didn't do that either. Let me go to CMCSA. Schlumberger was skewed bearish. Comcast is skewed bullish. Again, if you want to see those, you can check out that webcast. Skewed bullish. Where's our current stock price? Current stock price is up here. The stock moved on us. And so it's probably a good thing we skewed it bullish because if this were, again, a traditional butterfly spread where it looked kind of like this, and if the stock went up here, that'd be kind of probably pretty bad news on this. But in this case, it doesn't matter how high it goes. We're okay on this. What we really want to protect against is it going down a lot. Now, ideally, it's not up here. Ideally, it's right here. Okay. But for now, that's okay. That's not a problem. We're going to let that sit. All right. So that's those. Now, let's look at one more trade, and then we are going to wrap it up. I wanted to look at under long stock, which this is managing an options portfolio, but we have one that actually has options on it. Okay. So I have Bank of New York Mellon, and I have a protective put on this trade here right now. So you can see stock's doing great, protective put losing a little money, but the purpose of this is protection. So losing $22 on this, I don't know when we got it. When did we get in on this? We got in this on the 12th. We've had this in for like 3 weeks now. Does that sound about right? About 3 weeks? This protective put. We've had protection. Doesn't mean it completely protects us from all loss. And I'd say, the $22 it's cost us has probably been worth it. Now, in hindsight, would we be better off if we didn't have that protective put on there? Yeah, but we didn't know what was going to happen on this. So I'm just going to leave that on there as an example, but there we go. We're going to sit on that. All right, folks, what did we do today? We talked about some, actually, let me just answer one more question here. And that is question, let me see if I remember the answer. Where do you get the various groups to show profit and loss? I think you got to click up. Boy. Ben, maybe you know. How do we get this to show, each of these groups to show profit and loss? Let me just see. Delta, that is not showing me. I'm not sure right now, Lawrence. Good question. I fiddled around with it and got those. Let me see if I can do some research on that and figure out that for next week there. Because I'm not seeing it right now in that gear option here. This is what it looks like when I click on the gear, and I'm not showing that. So let me, I'll do a little research for you on that, Lawrence, and I'll come back next week with an answer for you on those groups. Okay, what did we do? Well, we answered questions today, okay? We talked about questions that I had regarding the risk profile tool. And risk profile tool. Oh, it looks like Owen has the answer. Go to the gear and then add a PL percent. Go to the gear and then add PL percent. We talked about analyzing trades. We talked about looking at specific types of trades that we haven't done yet, such as that synthetic with a long put attached to it. We analyzed existing trades. We looked at we looked at managing short verticals, iron condors, long options, and butterfly spreads. Okay, so we did all those. We also looked at the spread book today. What's a spread book? What does it tell us? How may we potentially use that? There we go. Hey, Ben, thanks for helping me out in the chat. And thanks for all of you and your participation. Thanks, Owen, for answering that question for me. And everybody, have a wonderful rest of the day. Coming up next, we've got trading price patterns, and we'll see you all same time next week. Bye-bye, everybody.